Hey guys, can you hear me? I think I'm mixed up. I thought the mark, is it moving? I thought the, excuse me, I thought the market opened at 4 my time. Unless it just has not gapped. Yeah, no. I guess we've got another hour. 5, yeah. Well, I am short the ES from Friday, right before the close. Well, yes and no. So I got on at 2:30 and then I had asked Cedric late last night. Well, it was last night for him to do a number of things and to change the time, and it just it kind of it got all mixed up. So I got on, I don't know, at 2:30, 2:40, something like that. But it was in the subject, it showed 7 p.m. So then I changed it to 3:30, and as I'm talking, I'm like, well, I got to write an email and send out, and then hopefully finish the installer. Well, when I write an email, it takes yeah, it takes quite a long time. And I said way more than I should have, but then again, um, I know I've disappointed some of you guys talking about, the update and when it's going to be out, and then a couple of times either showing up late or not showing up at all, just from, well, personal stuff, basically. I don't know, relationships falling apart and life, just life. It can be brutal. I didn't realize just how bad it can be, but whatever. There's no need for me to be crying about it because there's millions and millions of other people way worse off than I am. So I just felt like I needed to write something supplicatory in there, or supplicative. But that email just went out. Why won't you stay on top? So the email did just go out. You probably just received it, huh? Yeah. Gosh. Well, you guys mind just waiting like 2 or 3 minutes? We'll get some more people in here and then we'll kind of go over what we've got going on as far as Analysis Live, uh, what's going to be coming out this evening. I don't have very much. Well, I say I don't have very much, and then I say it take me 5 minutes to write an email, and it takes me 30. So it's in my mind about an hour, but which means multiply by 5. So it'd probably take me until about 9 o'clock, 10 o'clock tonight to finish it. But that's all of them, huh? That's finishing all installers all at once, which is 8 installers. So if you guys don't mind, we'll just wait another 2 minutes, 3 minutes. I'm just gonna step outside and look at the pretty lake for a minute, clear my head, and then come back, and then we'll get on it. Sound good? Good enough? Okay. Thanks, you guys, for being so peachy and not like that other guy on Friday. Okay. Hopefully that's Test 1, 2. You guys hear me, don't you? Yeah. Okay. Good. Jordy's asking, can I go over that risk spreadsheet beforehand? Yeah, I was hoping some more people could join before I did that, but then I imagine most people will just simply have to watch the recording anyhow. So, yeah, and I was kind of wanting to see if this was going to gap up or down, and gap up, stop me out, or gap down and look beautiful. I'm thinking it's going to gap up to right up in here. And my stop is at 3306. I'm going to back that up just a little bit. It's a lot of risk on this trade, but it's a potential massive winner. A lot of people would assume that the low is in, but not me. I'm thinking we've got one more wave down. But yeah, I'll go over that spreadsheet now then. So I've had a number of people write in or call and just talk about how well they've done the past few weeks. Bo's actually been doing a pretty amazing job. So Bo started off, I think he was one of the first ones with us back in, I don't know, 2015 maybe. So I started the company back in 2013, but it was mostly for building strategies according to people's predefined rules, or maybe I had to kind of help them define it in Bloodhound, and what they had at the time for the strategy portion of it, which was called Raven, which they still have. I think that still comes with just Bloodhound. When you buy just Bloodhound, you still have a strategy component that you can do some testing with. Nothing even remotely close to what we have with Blackbird now. But that's what I was doing for a number of years. It was more like 2012 actually, and then it led into me developing. Of course, you guys know this story. Most of you in here now, but not everyone does. So that led into me kind of going back to what I knew were the main driving components of the market, as far as, why does a swing high occur at this point in time and price as opposed to another one? And why is the high of the day here rather than there, or low? Why did it stop at 3180 and not 3195? So I had learned quite a bit at that fund that I worked for, private equity fund in Ecuador, for just a couple of years, two years, basically 2.5 years, something like that. But of course, that was right at the time the market was topping, and then that was 2007. And then, of course, in 2009, after it turned back up a little bit, and I was giving I was given much too much free rein to do whatever it was that I wanted to do, not knowing anything, but after the first year, assuming I knew everything. One thing that I did not understand at all was risk. Even though the guys that were managing Mr. Big Money's money did know and had been doing quite well, managing several dozen millions and posting some, 8 to 20% returns. And even in 2008, they only lost just a few percent, huh? They didn't lose all that much, which was surprising to me to find out. But of course, by that time, I had pretty much lost well over half, if not 70% of the 500 grand that I had been given to trade with. Why that was ever allowed, I'll never know. Well, I do know. It's because of greed. He thought that I was some kind of a genius because I graduated top of the class and just behind one Chinese girl who was a total nerd and never went out and did anything. And yet I went out every night. So he felt like I had some kind of innate ability to learn this stuff and learn automated trading, and I was going to make him an automated system that was going to just be an ATM machine, which at the time I thought sounded just totally crazy because I didn't know anything about trading at all. And but he kind of convinced me that if there's anybody that could do it, I could. And I said, yeah, that sounds right. Yeah, Daniel can do it. Well, I don't know if you guys have experienced this yet, but the market can be quite humbling. And if you're an arrogant little turd like I was in 2007, it can bring you back to reality and help you understand that you are really not nearly as bright as you thought you were. But if you had somebody giving you some proper education, as opposed to what Mr. Price Action Purist on Friday had to say about, what all did he say? This is all garbage, Daniel. He's lying, and you don't need any of these indicators. All you need is pure price action, blank charts, and you can make all the money you need to make. Just price action. You know who teaches that stuff? Besides 50 other people. That idea essentially originates with Online Trading Academy. And I know because that was one of the first places that I went. Back then, when you searched for online trading academies, well, Online Trading Academy comes up as number one. And of course, now they have places all over the universe. And from what I gather, they're being sued. So Mr. Jet owner with his own private jet is now in some sort of a class action lawsuit because he's telling people that after 6 weeks or whatever it was, by the end of that, you'll know how to trade. Well, by the end of that little course that I did for $4,500 for 3 weeks or whatever it was, Yeah, I knew how to enter long and go short and put in a stop. And yeah, I especially knew how to cancel the stop when it was going against me and then doubling down in martingale style, and quickly learned how to blow an account. Nobody knows what I'm talking about there, right? Jeff does. So yeah, I learned all that real well. But did I learn how to make money or save the money that I had? No, I didn't learn anything. I didn't learn anything about risk analysis or risk of ruin, Monte Carlo analysis, how to build out a proper trading plan, how to build out rules that you can actually uh, adhere to grade yourself and measure your results so that you can thereby make improvement. Who said that? Somebody like Kepler or whomever it was. Uh, Whoever it was. If you can't measure it, you can't improve it. Pretty much anybody that's ever done any sort of engineering or modeling of any kind will know without a doubt that if you cannot measure it, you cannot improve it. Just like in baseball. I mean, that's why we kept our stats. Uh, and I've always been incredibly competitive. I was Mr. Baseball for the longest time, pitching, catcher, and third base and shortstop. And yeah, we all kept our stats so that we could improve them. And we made it to All Stars, only to lose, but we did that 3 years in a row. Lost lost the last game every time. But anyway, that's essential that you first of all know how to do it. Second of all, understand what the statistics mean, and third of all, know how to uh, preserve your wealth according to your stats and position size appropriately. Money management. So if I can make this a little bigger, I'm sure that I can do it. There's probably some kind of control plus. Nope, not today. Am I showing the spreadsheet? Yeah, yeah, that's what I'm trying to do. It's the view tab. Thank you, Jordy. Big enough, huh? So in other words, shut up and teach me the spreadsheet. Gotcha. So this is created by a good friend of mine. And the point of this is, and I'll fancy it up a little bit before we give it out to everybody. The point is to stress how important it is to know, first of all, you know, based on your account size and the charts that you're trading and the size that the stop, well, the minimum size that the stop must be, what vehicles or instruments can you actually get away with trading? All right, so over here on the right, we have something called Monte Carlo analysis. It's basically running um, trial runs using random generated data, trade data, according to whatever metrics I place within these boxes. So this is kind of I don't want to say it's backwards. Well, it is kind of the backwards way of doing it. Typically, you'll take your results, you'll plug it into a Monte Carlo simulator, and you can find those all over the internet. Uh, the one that I would get, or the one that I would suggest, would be um, from Mr. What Davy something Kevin Davy. I think it's kjtradingsystems.com or something. Just look up Kevin Davey, Davey, and he's got a free Monte Carlo simulator that you can plug your stats into. This is kind of taking the opposite approach, which is starting with what your stats would end up being, and then going backwards and figuring out, okay, what should my uh, what should my stop size be? You know, if I'm going to be making, let's say, 45% winning trades, which is the probability to win here, PTW. This is the percentage of winning trades. Let's say it's 45%. Okay. What is the minimum win-loss ratio that I can get away with and still have the potential to grow the account over time and not hit my risk of ruin before starting to see that growth curve? Well, before starting to see the curve go into the growth phase. Okay. A lot of people will trade a small account. They may have a good trading plan. Most people will never adhere to their own trading plan, unfortunately, which is why you do need some sort of accountability, uh, which I think we'll have kind of built into what we're developing for 2020, 2021. But without accountability, yeah, it's a little bit difficult to adhere to even your own rules. It's the main thing I get asked for. Daniel, can you please build me something that will keep me from being able to move my stops? And I'm like, nah, sorry, man. I wish I could, but it's kind of, you know, something you got to do on your own, unfortunately. So that's people's biggest problem, not understanding any of this, but even more or even worse, adding to losing positions, moving their stops, canceling their stops, or going all in and just risking everything on one single trade. Let me open this door before the cat breaks it down. All right, hey, Charlie. Sorry, buddy. Yeah, but not yet. It's not mine, first of all. We haven't really discussed that yet, but whoops. Yeah, it's at some point in the not too distant future, we will stop it. What are you doing? Crazy cat. Um, I just want to add a couple of things to it. I want to have, so this is 3 dry runs here. One is without applying the money management rules. That's the gray line. So we have 1 random run without applying money management, which is to say without increasing the position size, number of contracts. And then the other 2 are just 2 random runs. I want to do, say 100 or 50 or 30. It may not be necessary, but I'm not 100% sure yet. So I want to work on this a little bit before I actually release it. But yeah, he's put a lot of work into this. It's the most detail of any I've seen so far. And it's showing you up to 1,000 trades. So let's get into it. And it does have VBA, so there are macros, and it's got some coding behind it outside of Excel. So anyway, so let's say that a lot of guys want to scalp, right? They want to scalp. Well, if you're scalping, what chart are you trading? Maybe you're trading the 2-minute chart, or maybe you're trading the 1-minute chart. Let's just look at the average range of the 2-minute chart for the ES. Let's look at the 1-minute chart even. So even the 1-minute chart is 10 ticks average range. So let's say that you're only going to take trades that occur on the 1-minute chart. Okay, you see how these are little green, painted green here, painted red there, red here. So those are potential setups on the 1-minute chart. They're not trades. They're just telling you when you've got a potential ABC. And then if on the other charts, which has the volume and momentum divergence confirmation, if those also give the signal and you're also at an area predefined by the market geometry, then you've got all 3 things in place for the trade. Okay, so let's say that, for instance, you have everything lined up for this short right here, which happens to be right on the end of it. Yeah. All right, at a minimum, you want to use the largest value from that operative time frame as your stop value. Otherwise, there's a pretty good chance of really, he didn't put the code up. Sorry, somebody's just bringing something to my attention here. Well, that would not be very good, would it? Oh, no. Okay, sorry. Yeah, I don't like the way that works. That's kind of pointless. So when you hover over it, you see that? It flips. TTP 2020 is the coupon code. And if you buy or upgrade to the Master Suite, then you'll get 2 free months in Analysis Live. Okay. So there it is, TTP 2020. So right, dependent upon whichever chart is the operative time frame. It's at least the way that we do it. If you did it another way, you would still be, sorry, let me just do this real quick. Most likely, if it's less than that, you can still be ticked out pretty quickly out of what would end up being a good trade, just because you have, a little stop run or just a little bit of random price action that ticks you out. So we'll look at where we would place that in the spreadsheet. So that would be the minimum, 16 ticks. The way that we've done it is, it's very weird. It keeps opening. Have you guys noticed that the forum is opening 2 windows sometimes? Seems like it's only when I pin it to the taskbar that it does that. But anyway, so here we have a spot for your average risk. It's really the average range. Okay. So we were kind of working that out and saying, well, that's the minimum, the highest of these 3 values, but typically you want it probably between 1.5 and 2.5, the size of that value. So let's say that our average range is 16. Maybe we would use a 20 tick stop. Okay. Now that's stop needed based on percentage risk. Okay, I think he did that one maybe backwards. Yeah, that's about right. Well, let's just assume you're using not a $50,000 account. Let's assume you're using a $10,000 account. Okay. Yeah, then it wipes it out. You're no way ever are you going to get a positive growth curve there. So how much are you going to risk of your base starting capital per trade? And what is the tick value of the market traded? Well, ours is 1250. And if we're risking 2%, and what is the full point value of the market traded? Well, that's what, 1530. Do my math right. Is my math right there? It's 4 ticks per point. I sure hope so. 30, yeah, it's 50. What am I talking about? Per contract. What is the current average range of the time frame? Well, it's 20 ticks. Okay. So this is stop needed based on the percent risk per trade. Okay. So probability to win, if you're getting above 50%, chances are you're probably risking as much as you're making. Not necessarily, but if you're starting out, That's usually the case. You're kind of risking as much per trade as you tend to make, and you can kind of get away with that for a little while and break even. There's a lot of people that I talk to that claim that they've been kind of breaking even for the past 2 years straight. That seems a bit difficult to believe. Most people don't want to admit that they're losing money, that this has gotten the best of them. I didn't. Um, to be quite honest with you, I tried to cover it up a number of times when I was trading other people's money. I didn't try to cover it up, but let's say that I would dodge the question. But at some point, of course, they log in and see, and it's like, oh, this looks wonderful, you know. So it is pretty embarrassing to admit that you've not been able to succeed at something when you're used to succeeding at every single thing that you do. It's a pretty rough thing to deal with, really, in fact. So it feels humiliating, but just know that it's not. It is the most common outcome for the majority of every single trader that will ever come into this game. The vast majority, what do they say? It's well over 90% of traders will lose over 90% of their capital in the first 12 months. That's rough. And then over the next 6 to 8 months, the majority of those will end up just blowing the rest of it. So, all right. So what is if we have, so this is essentially our minimum risk to reward ratio just to break even. Now, this one is a little bit, okay, let me show you how it's working here. So we've got one tick, and I think I got something wrong with my macros. Cannot divide by 0. Okay. Well, I'll figure that out over here. Basically, we're adding in 1 tick of slippage for the entry and 1 tick of slippage for the exit. Okay. I understand why he's doing that. But let's say that for the ES, on average for a stop, if your stop is 7 ticks away from your entry, that 7 ticks is going to become an 8 tick loser. Okay. Because of 1 tick of slippage. And that's maybe now it's a little bit less, or maybe now it's a little bit more. There is a way to figure that out. So what I would task one of you guys with, I'm sure one of you out there, maybe Jordy, has thought about this. But so when I got into this a long time ago, I became really good friends with an Indian guy who lived in New York, and he ended up going his way, I went mine. We were studying GAN together, astrocycles, and just all kinds of crazy esoteric stuff. Brad Cohen, all that craziness. So he ended up getting a job at a hedge fund and then offered me a job in 2012, 2013. Yeah, 2013. So I went up there to New York and I interviewed with him and whatnot, and could have taken it, but I didn't. One of the things that they did was they took just kind of a test account, and they took, I think it was 300 trades, round turn, market order in, market order out. and they did it at different times per day. So they did it right at the open within the first 2 minutes. They did it, I want to say, every hour to hour and a half throughout the day for every single futures market. And they came out with a list of average expected slippage per market order, per contract, per instrument. And at the time, 2012 or 13, ES was 1.1, NASDAQ was like 2.4, gold was over 3, crude was 2.1 or 1.8 or something like that. And I don't remember much else, but I remember ES being the lowest. And at certain times of the day, it was 0.9. So a little bit less than 1 tick of slippage. But almost, you know, you can just bank on it. On average, you're going to lose an extra tick on your stop market order. Okay. But at your target, you're really not going to have any slippage at all, are you? Because you're not going to get out on a market order. You're going to get out on a limit order. So 2 extra ticks of slippage built into this is I think a bit much, but that's just kind of my explanation as to why this number is as high as it is. In reality, if you're using, the results that you actually have from your live trading, all that is already built into the numbers. So you don't need to add more to it. But see, we're trying to go in reverse. We're trying to go, do this from the flip side to figure out what can we safely expect or not expect. Does that make sense, the way that we're doing this? Because we're not starting with a list of trades. We're starting with these values, and then we're running random result trades to see what the expected potential growth or decay of the account would be. Okay. Hopefully that makes fairly good sense. All right. So if we're looking at trading capital required per extra contract, 10 grand, well, let's massage that a little bit. Let's say that we're just day trading. So we're going to allow ourselves to take, let's say, 1 per $4,000. That's still a bit high. I mean, I know that they give you, they give you $500, which I think is predatory, per contract. And I've had people call me up and tell me they've got $5,000 in their account, which means that they can trade 25 contracts. And I said, really? Is that what you think? Because you'll lose that 5 grand in about 5 minutes if you do that. It's just insane. But that's how people think. They don't think about saving their money. They think about how much money they're going to make. And I can understand why, watching some of these guys' presentations, when they show you how to take $1,000 to 1.1 million in 12 months. Yeah, well, that's just never going to happen. So put that right on out of your mind. Your main focus needs to be keeping the cash. All right. Well, that started to get us a bit of a chance here. Rather than limiting us to not being able to take another trade once we got below the amount that is required to trade one contract. Let's say we multiply that by 3. We're going to start with $12,000. Okay. But we're still going to start off with 1 contract per trade. Okay. Until we get over 16. So it'll be Essentially, once we get over 16 grand, then we'll add a second contract. Okay. But for the initial size of the account, we're just going to do one contract. And then we may let it go up to, say, 3 contracts. Oh, well, that just screwed us right up, didn't it? Cost of the round turn. What do you pay, Jordy? Exactly. It's not what you make, it's what you keep. What is a round turn in the ES? It's about $4. Yeah. Let's just say $4. Slippage, 1 tick in, 1 tick out. It's not $20. Let's just make it 1 tick. So let's just make it $12.50. Okay. So I think you can kind of get away with saying that it's going to cost you $16.50, but let's make it even less than that and just see. Let's just say it's just $4. Maybe it's half a tick of slippage just from the fact that we've got 45% winning trades. Let's make it an even 50, so it's actually cut in half. Okay. So now that's your minimum R multiple. Well, naturally, makes sense, right? Because if you're winning 50% of the time and it's costing you $8 per trade, that's just built right into it. Well, then you've got to make at least an R multiple of 1 per trade just to break even. But that seems like it's a little bit dicey there. Might need to check that one out. All right, so maybe we can go up to 4 contracts, let's say. Okay. So this is maxing out at a total of 4 contracts with the initial size of the trading account. Minimum number of contracts is 1. That's what this gray value is. So just by applying money management rules and increasing the number of contracts based on the amount of money in the account as you're growing versus keeping it fixed, just look at the different trajectories here. Pretty incredible. Now, really, what we're looking at is the average amount for the winning trades. Guys, I'm sorry, I'm gonna have to step away for a second. I gotta blow my nose here. These cats are killing me. Just give me 1 minute. I'll be right back. I said that, and Charlie goes, I think he knows what I'm talking about him. Be right back. All right. Well, I can barely breathe, but whatever. All right. Now then, there's the open, isn't it? Real quick, let's check it out. Where am I going to be in about 2 seconds? Not Well, it's at least doing what I expected it to do. So I've got to see one more high, at which point I'll add one more contract. I can add up to 4. Well, I can really add up to 10, but you guys mind if we come back to the spreadsheet in a moment? I want to try to manage this. Let's see what crude is doing real quick. It's the ES, or that's the other one. Yep. Well, no, there's some randomness built into it, so I'll touch on that a little bit. That's the part that I'm a little hazy on. I just got this the other day. Well, I got it Friday morning. He had sent me a version of it prior to that, but I really didn't fully understand it. Crude is, I think, going to be the one that disappoints, but we'll see. This is a pretty huge stop on this trade. So yeah, to be quite honest with you, it's a little bit new to me the way that this works. I'm used to having stats first and then plugging them into a simulator that then does, multiple dry runs and kind of randomizes it to show you what your maximum number of losing trades in a row will be, which is your risk of ruin, your maximum drawdown. It's like the Six Sigma event, Murphy's Law. If it can happen, it will happen type thing. And that's usually when people give up and move on to something else, is when that happens, when they actually experience that maximum drawdown and they're just about to turn the corner. That's usually the point at which people give up and move on. And they move on to something that's almost guaranteed to be no better, but may even be worse. Okay. Let me just check this out real quick. It's obviously the one. Well, my stop's a little bit gigantic, but you see what I'm going for, right? I'm going for at least 2.5 to 1 always, but it's typically 10 to 1. That I'm going for. It's not like I always make that. That would be crazy. But I do have a realized win-loss ratio of 2.85. At least I did before I killed my Dell. It's not the one that went flying, but it's the one that's sitting in the corner, worthless. By the way, computers don't fly very well. I don't think they were meant to. So that's actually going for about 4 to 1. Yep, exactly, Bo. So that's Bo. Bo's staying up late. So he's the one that's been helping out big time in Analysis Live. And he and Cedric just put up a recording of his analysis from Friday on YouTube, which I included in that email I just sent out a little while ago. If you found that you're not getting that email, let me just check the title of it. Then please check your spam or write in and tell us that, hey, I'm not getting your emails. I've got a list of all the people that I know for a fact are not, and I'm moving to a new platform. It's just a heck of a lot bigger process than I expected it to be. When is it not? Everything is like that for some reason. Technology. Yeah, this is the one right here. So this is the title. 25% off an analysis live trading room recordings, live webinar now. If you did not receive that, then please let us know, or look in your spam folder and mark it as not spam, please. Yeah, so that's our risk to reward meter. Inside of this toolbar, there are so many different options. There's 1, 2, 3, 4. It's about 30. Well, it's not 30, is it? It's about 22, something like that. 28 functions. Quite a lot. So that would be within, well, it's the objects one. Which one is it? Goodness gracious. I'm just always used to hitting the hotkey. See, I hit the hotkey and it puts it underneath my cursor. It's this one right here. Price markers. So that's this little button right here. And then you can set it up to do whatever you want. However many risk to reward values. And then you've got, I don't know why they should be open by default. I think it's because I collapsed them. But yeah, that's where you fill in what is the R multiple and the number of contracts. We didn't say contracts because it could be futures, it could be stocks, it could be Forex, you know. And that's the opacity of the region and the color. So pretty cool stuff. And it's adding up those two contracts because I deleted the third, as they are about 2 R multiples away. Because I have 2 stops. So it's a potential R multiple of 4.14, which is to say I'm risking about a quarter to make $1. Or I'm risking $1 to make $4.14. Yeah, you'll have one from zoom.us as well. Zoom.us, which is a service that we're using now for the webinar that I want to get away from. And as soon as I get this new app working, we'll be using Vimeo exclusively, which is going to be great. All right, so yeah, to be fair, I need to work on this spreadsheet quite a bit more. I've been focusing on update, and I am literally almost there. It'll be out before you're trading in the morning. But the Blackbird templates had a pretty big issue, and I've had to recopy them all. That's just one of a couple of different things. It's taken me some time, but I've figured out all the issues now. I'm just copying files, but that's still, takes some time for sure. All right, so tricky spreadsheet to be sure, but it's really the main idea behind it is to show you what is, for your probability to win, your percentage of winning trades, what is the minimum risk to reward ratio that you must have. And let's get this back up to where it's actually making some sense here. Let's say it's at least a tick, so we'll go 1250. What is the minimum risk to reward ratio? And then, therefore, what is the average winning trade? What does the size of that average winning trade need to be versus your average losing trade, which is your win-loss ratio? It's closer to your expectancy, I guess, but yeah, so you need, if we're looking at 20 ticks, and this is points. Okay, that's what was confusing me before, because he's doing it in points. In order for this to work for 4x as well, I think I'll have to massage that a little bit. One second. Plumber's on his way now. Goodness gracious. I'm not going to go into that. Let's just say the kitchen has been flooded for a couple of days, and I'm carrying out about 5 gallons every 3 hours. No, more than that since Thursday. Yeah, it's about 3 days, I guess, 4 days. So anyhow, yeah, this is in points. That's what had me messed up before. So, right, if the average stop is 20 ticks, which is 4 points, in order to make money, all right, this is the minimum to break even, right? That's your minimum win-loss ratio. So what is, in order to make money, what then is needed? Well, based on the percentage of risk per trade, which is 2%, that says that you can get away with an 80 tick stop with one contract. 2 times 12 is 240. I'm not quite sure that's right. Let me see this. H25. Average losing trades. Green box based on percent risk. 240. Okay, right. Okay, so he's just plugging in. I see what he's doing. Okay. Average dollars for the winning trades, average dollars for the losing trades. All right, well, let's just say it's exactly 240 and exactly 257. Oops. Well, then you've got a pretty rough R multiple there. It's negative now. Negative in my mind is below 1. I'm not doing the best job of really explaining the spreadsheet. I think I'm doing more confusing than anything else because I don't know it as well as I should. In order to give this presentation, I was focusing on trying to get these updates out more than anything. This is probably best done once I've adapted it to work outside of the range of points, but just on a tick by tick basis, and just get rid of this whole points thing in here. Otherwise, it's not going to work for Forex and stocks. I guess technically it could, but it's just one more variable that's kind of making it a little bit confusing. The idea behind this is to show you, though, that if you have a very small account, let's say you've got, well, I'm not going to say that, but let's say you've got $5,000. Okay. And you want to risk $2 per trade, 2% per trade. This is proving to you that you can't even begin to think about trading the ES. I did it, and next time we do this, we'll log into my brokerage account, and I'll show you the actual brokerage statements and trades all the way up from 5 to 29 grand, and then my nosedive 20%, 25% thereafter, because I started doing all those things that I was not supposed to do, which is moving my stops, adding to losing positions. But, you know, jokingly, I used to say, really, a lot of that was me just being lucky. And people would say, yeah, right, luck. Okay, sure. But the fact of the matter is, I was trading crude oil, 6E, and the ES, one contract, though it may be, with a $5,000 account. The fact that I was able to grow it is literally a coin toss. Because according to my results, and back then they were better. I did have by the end of it, I think it was 48% winning trades. I remember I was all bummed out when it got below 50. And the R multiple, or the win-loss ratio was 3 point something or other. It's never really been for any length of time beyond 4, but it was just above 3. So even though I had stats like that with a pretty big profit factor, with a $5,000 account, your maximum losing trades in a row will still be upwards of 7 or 8 trades in a row. Let's just get this back to normal so you can see that at least. Let's go 15 grand. So even at 50% profitable, 50% winning trades, and here you're just barely making a little bit more than you're losing. So let's say for the first contract, let's say we make it a little bit bigger than, let's say we actually make a realized 2-to-1. So let's go 480 to 240. even with a growth curve like that. And that is impossible. I tell you, that is impossible. And let's go up this to 4 just to see the difference in money management. Unbelievable. Okay, let's not get carried away here. Let's take it to at least 45, because then you're looking at, okay, maybe that's possible if you're, a seasoned best trader in the world type stuff. Okay. What is your risk of ruin? And what is your maximum drawdown? And this is only 3 dry runs. So that's where I think once we add in, 10 or 20 and look at the standard deviations of those, but it's kind of baked into this. It's weird the way this, how do you call it? Goodness gracious, I'm so tired from working on click, 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 click all day and all night. It's a random generator. The way that kind of works is a little strange, but even with beautiful, perfect stats as such, you've still got a 23% drawdown, and you've got maximum of 8 losing trades in a row. And look at this one. You only had a 5% drawdown, but you had 12 maximum number of losing trades in a row. Is that not just absolutely crazy? By the end, they kind of even out and they achieve the same final result. But when you've got 12 losing trades in a row, that feels like crap. Imagine you're taking 3 trades a day, maybe 2. And for all of you guys that are taking 20 or 30 trades a day, oh man, that's a surefire way of doing yourself in real fast. Which is why I am using this as a way of promoting the idea that you trade micros. I really can't condone Forex just because of the amount of deceit built into those vehicles by the brokers themselves. And I can't abide it, and I can't tell people or suggest that they use Forex to trade with. But with the micro futures contracts, trading a smaller account is doable, and Bo has done it. So it took Bo, and this is not going to sound wonderful, but this is reality. It took him about, he had to blow the first account like we all do. And then listening to me, he kept trading in sim. He didn't have a whole lot of time every day, maybe a couple of hours a day. Trading sim, looking at larger time frames, holding some trades 2, 3, 4 days. Though you probably didn't hold more than 5, 6 days tops, something like that. Most of them were probably 1 to 2 days, would you say? Something like that. After about 4 years or something, he was able to double, I think it was 2 simulated accounts, right? Or was it just 1? Once you got to the point to where you doubled 1 or 2 sim accounts, then you went live, and then he took 10 grand to 20 in 6 months. But it took him 4 years to achieve that or more. So, just like it does if you want to be, just if you want to have a bachelor of something, what if you want to be a lawyer? Is that 8 years, 6 years at least? So, you're not going to quit your job, take your money that you've saved up for your retirement, put all of that at risk, not understand any of this stuff, buy a system that I'm selling, or heaven forbid, some other person is selling, because, well, let's just say I don't have a whole lot of faith in what's being sold out there right now. And well, let's just be frank, it's garbage. How do I know it's garbage? Because I'm probably the one that built uh, the tests for half of them to see if it worked or not. Did they stop selling it? Hell no. They just said, oh, well, that just means you've got to add some discretion to it. It's like, yeah, well, right. How do you do that? That's why you are the holy grail, and money management and risk to reward, going for targets that are larger than your stops, trading with at least some set of rules so that you can at least achieve consistency at hitting your target. And what is your target? Your target is following your rules. And if you can do that, then you can see yourself start to grow, and you can see those numbers start to change and go positive. But if you're doing that with real money, it's just a heck of a lot harder for that to happen. When real money is in the equation, and it's money that you need to live on and you need to pay bills with, uh, you can forget about it. It's just not going to happen. But if you can actually take the time, trade a sim account, do the amount of work that's necessary to learn this stuff, and it is a lot, learn from some people that have done it and can prove that they've done it. There aren't very many of those out there, first of all. Well, I mean, look at this dude. So this is a guy that made the spreadsheet, obviously. Who else would it be? Because he knows what he's doing. He spent the past 6 or 8 years studying this stuff. He's an engineer, so he knows quite a lot about numbers and statistics and whatnot. And he realizes that, oh, it's actually risk and position sizing that is the most important, not necessarily the methodology. Although if you don't have a methodology that can make money, then how are you ever going to make money, right? Now, this is a very, very low number of trades, so it's not statistically significant, okay? This is not achievable over the long run. He just happens to be within this phase of the growth curve that's going straight up, this orange one right here. This is how he started off, like this orange one. He could have just as easily started off like that blue one there, and I wouldn't be showing it to you, right? Even though this is perfect and barely achievable, it still goes negative. If I zoom in on that, it goes quite negative. In fact, it goes 23% negative. If you're a fund manager, you're going to have people calling up asking, give me my money back because you're a loser. You're an idiot. I'm out of here. Mm-hmm. And you're busy trying to tell them, well, whatever. If you'd hang in there, you'll see it turn the corner. But yeah, let me get you your money. Hang on. So this, I'm not going to lie to you, happens to be, yeah, that orange curve right there. And he's at about trade 32, which is about right here. And what has he done? And he says, it's all because of you, Daniel. But it's not all because of me either. It's because of him and what he's done. I'm not taking his trades for him, and he's not taking every trade that I'm taking. He's taking his own trades. He's learned some stuff from me, but he also knows quite a lot, and he's done a lot of homework, and he's done a lot of analysis, and he's done a lot of number crunching. He's really good at these spreadsheets, and he realizes what it takes to actually make money trading, which is hang on to your money. Don't give it away. Don't lose it. Do whatever it takes to keep it and keep as much of it as possible. But at the same time, your winning trades need to be bigger than your losing trades. I don't know why that's so difficult for people to understand, and how anyone out there in their right mind can tell people to go for a 5-tick target with a 7-tick stop that becomes 8 ticks or 9 ticks or 10 ticks, depending upon the instrument, how they're going to make money. They've got to, what is it, percentage to break even is like 72%. So they'll have to have 72% winning trades just to break even, which means they have to have 80% to make money. Well, this guy happens to have made 82% profitable trades, and 2 of them were 2 contract trades, so it's really about 31 trades, I guess. I can guarantee you that number will not be that high by the time he gets to 100. And this win-loss ratio will probably drop a little bit too. I hope it'll increase as this number decreases, but we'll see. We'll see. But he's but this is also a guy that's made quite a bit of money over the past few years trading another methodology, but it's longer term, and I don't know that much about it, so I'm not going to talk about it. But he's had some success in the past, but was looking for some ways to make his system better. Used our tools to do that, and he's applied his own techniques. He's occasionally taking a breakout in certain situations. I don't take breakout trades, but using our tools. So looking at the trades individually sheds a little light on it, though, because you do have a couple of big losers in here. So I'm afraid that once he gets up to about 200 or 300 total trades, that there's going to be some in there that are not just 2,600, but maybe 30 or 4,600 per contract. So this is what worries me right there. But then again, he's got 2,800 profitable, 23, 3,200, 29. So it's evened out, But again, it's 30 trades. I shouldn't show stuff like this because it's sensational, and I'm anti all of that. I'm not trying to talk you into something. I don't want you to spend your hard-earned money on something that I've got to talk you into buying. I just want you to understand that this is a risky business. I'm not trying to, certainly not trying to talk you out of it, but I want you to understand that it's no easy task. There's a ton of people that have entered into this arena recently. It's the highest all-time of any year in history, new brokerage accounts that have been opened. And the rate at which they've opened is astronomical. So we've got a ton of what people refer to as quote unquote dumb money coming into this, and they will all blow through their first account. It's inevitable, invariably. Each one of them, however long it takes, they'll spend them, whether it takes them 2 months or 2 years or 2 decades. And I can't say that's true for everybody, because there is that 3 to 5% that will do what is necessary. They'll find the right mentor or teacher. They'll find the right system. They'll learn the right techniques and not study those things which lead them down the path of failure. But this is it's a numbers game. Like, just to put it in perspective, we're little Davids up against the most massive of Goliaths, trading against the smartest, most capable people in the world that are backed with the most, that are backed with amounts of money that you can't even fathom. The numbers don't even make sense. And they've got all the best technology. And I tell you what, while you're watching TV or doing whatever, those guys are working on honing their edge. And they're making it as sharp as it can be. And they are not easy to beat. But if you start off knowing these things, and you know how to keep your money, and you know how to position size appropriately. I started off with that $5,000 account, trying to show people that it's doable, because it is technically doable. But I mean, talk about putting it all on the line. What if I would have gone into this blue phase here? I happened to start off like this other guy has, and hit this orange growth curve initially. What if I would have gone into that blue portion there? Would you even be here listening to me? Probably not. I put it all on the line, and I did it in front of everybody. Granted, I took a lot of trades outside of the trading room. And if I had a bad day in the trading room, boy, I would do whatever it took to try and make that money back by the end of the day. And that was what ended up doing me in, trying to make back what I had lost at the end of the day, before the end of the day. That's what got me into my downward spiral, because I was trying to be Mr. Big Shot. It was right before a webinar, and I was going to show everybody I've taken $5,000 to 30 something grand, and I was going to be so cool. And I was at 29,300. I just needed $700 the day before the webinar, or 2 days before the webinar, or something like that. And I lost $1,000. It's like, oh man. So the next day, I lost $500 in the morning. I'm like, uh-oh. By the end of that day, I think I had lost about 3,500 bucks. And the next day I lost the same, and that was it. And I stopped. Mm-hmm. Yeah, at least 3 to 1. That's right, Jeff. Yep. Which is why the market geometry is so important. That's what it affords us. It tells us where we're trading to, where we're likely to trade to, and where our stop needs to be in order to make it there. So it would appear to me that crude has potentially found an interesting low here. And now we're going to go up and make one more high. Well, if it does that, I will actually add one more contract short. But I've been in this trade since Thursday. So I'm getting a little tired of it, to be quite honest with you. But yeah, let's say, just strip this thing down bare real quick. So let's say that I'm looking for a short in here. Well, you always hear me talking about low before the high, high before the low, whatever. This is what? It's the first low after the reopen. So is this one more significant, or is this one at 7 o'clock? That's one of the things that is a nuance that is just not glaringly obvious, is it? So anytime I'm talking about low before the high, high before the low, you're looking back to the left from the high, and that's where you're starting your drawing from. So let's say that I just choose that one, and that's the lowest low. But is it? That's the lowest low there. Okay. So even if I chose that one, I still would have gotten short here. How would I know where to get out? If I were to take short 2 contracts here, what method is going to tell you where you need to get out? Is there a good one out there that you know of that I haven't seen or tested 100 times with 300 other people? I doubt it. Maybe you've got some new secret, but I doubt very strongly that I haven't built systems with it and tested it 100 different ways. This is the best and only way. Between this and volume profile, there really is no other way. I mean, you can add to that just simple looking to the left for lows and highs market structure. I mean, that's one of the things we do on top of this, right? Because you've got some highs here. You've got a little swing high there. Whoops. You got your first little retracement high down from this level. Out of the main low, that's your first high, out of which it does turn down. And then it puts in a little low right here and turns up. Well, that coincides with the bottom of this channel. So if I were short from that high and I were day trading, and this happened to be from 9 a.m. until 11 or 12, or whatever size chart it may be, because this pattern will, it'll look like this on 100 different charts, any and every time frame. That would be where I would take my first half off. And it just happens to be 33 ticks, which is not very much, but if that were an hourly chart, well, that would be about 210 ticks or something, right? So let's see, what time is it? That's what we're here for, Jeff. I mean, that's really why it is that I'm partnering with a couple of guys. I mean, I can't do it alone. It's too much for one person to do. The guys that I'm going to partner with have been trading for years. Some of the most adept and brilliant men I think I've ever spoken to. And over the course of 2021, well, from now until then and through then, we're going to be building out the Academy of Trading, and it's going to be a master's course in trading, because it has to be, because of people like Online Trading Academy. It makes me sick to my stomach to think how many elderly couples are now homeless, or worse, maybe even killed themselves or each other. Like, you wouldn't believe the stories I've heard, because some con man conned old Jerry or whoever, John, out of taking his retirement, giving them 10 grand, and taking 150 of it and putting it into his trading account and trading with it, losing all of it the first year, doubling down, putting another 150 in, and losing the rest of that in the next 2 months, and then taking a mortgage out and putting that in and losing that in the next 2 weeks. That's a true story. That stuff just makes me want to kill people. So, yeah, we're going to be anti everything that is. And we're going to be trading live accounts. So, and every single piece of analysis that we're doing is all available for every single person to see in real time. This past week, I've done it all live. At least what I've done live. And what was supposed to be an hour and 45-minute sessions. Friday's session was about 5 hours. So you can kind of understand why I must partner with people that are structured and organized, because old Danny boy has no concept of time, evidently. Because I've melded it with price, man. Every time I think about time and what time it is and schedule and stuff, I immediately mix it with price, time and price. So it's totally messed me up. That's a good one. I got to remember that. Why are you late again? Man, at 2:00, I multiplied it by price and thought it was 4. That's what we're doing with the market geometry. If you have no idea what I'm talking about, market geometry is combining time and price, which is what Gann was trying to say in his old syphilis-ridden mind. He could have just left it at that, and everybody would have not wasted 10 or 20 years of their life trying to figure out his most retarded of books, The Tunnel Through the Air. Yeah, it's all about time and price. So that's what we're doing with market geometry is we're attempting to forecast. So this is the high before the low. And what do the academics say? They tell you that it's purely random, totally random. Any attempt at forecasting what the future price of any trading vehicle may or may not be is a total fool's errand. The only way that you can make money is by luck and by buying and holding. And tell that to Mr. Soros or any of these hedge fund managers that literally make money. Tell that to Goldman Sachs. Price action is totally random. Give me a break. How is it that we're able to do what we do? If it were totally random, then we may as well just all hang it up right now and just stop talking about it. And yet that's what I not only have learned from the academics, but had to take tests on it and pass them. It's kind of like learning about evolution. Yeah, we all come from some ancient slime at the bottom of the sea of nothing. It turned into the human mind. It's brilliant. Let's believe that. Sure. Yeah. No, it's got order to it, and that order is decipherable. And that's what we do on a daily basis. So I'm going to take about a 5-minute break because my mouth is so dry I don't think I can speak another word. But if you're here when I get back, then I'll go over a little bit about what we've got coming up this coming week. So rather than leaving you guys in the lurch, as it were, and just having this forum with pictures and videos, I'm going to have an app which is quite amazing that will afford me the ability, I don't even know if that makes sense, that will enable me to hit the go live button at any time I see anything setting up. And it will be instantaneously recorded, tracking my mouse on every screen, and live streamed to you via that app on your phone or your desktop, with which you'll be able to give notifications to your email or your text or whatever. And that's how we're going to manage this going forward. And I think it's going to be a game changer. It's going to be awesome. It's going to be quite cool. So I may go into that a little bit. I wanted it to be a surprise, but I can't keep my mouth shut to save my life. So don't tell me any secrets, because I'll probably tell them in my next webinar. So, all right, I'll be back in about 5 minutes. Yeah, you said it. That's right. Just like, I don't know if you guys can see the Zoom chat. Spike Ali, is that you, Miss Sandy? The guy that was supposed to be keeping the books committed suicide and apparently had everything under just his signature. Yep, that's it. Because people cannot admit that they're wrong. They lost. Nah, Jeff, you don't have too many questions. Everybody has. We've all got a lot of questions, but that's why I'm busy trying to get this freaking update out so that we can start answering all those and do it in a way that is not chaotic, which is why I need the help. So 3 heads is better than 1. Be back in 5 minutes. All right. Now then. So how was I able to get to the point where I could actually see through all the nonsense after having bought pretty much everything out there? Thankfully, I had someone paying for that for me, because Lord knows I wouldn't have bought all those things. But he wanted me to learn all that there was available so that I could then begin to work on fully automated strategies. And of course, I didn't know programming, but I did know how to find trading rooms, of which there are many, were many. That number's been cut in half over the past few years, but I tell you, it wasn't an easy road. But coming back full circle to, why are we any different? What have we got that no one else has? That's one of the things, Frank. Yep. So Elliott wave was key in my understanding of kind of why the markets move as they do within the framework of human psychology. This is where I should be adding one short right now, but I'm not going to do it. So a lot of people scoff at the Elliott wave theory, even though it's really a principle. It's just when there are a lot of people buying and selling, the more participants there are, the more the waves within, the really long, strong trending moves, the impulse moves, and then the corrections retracing part of that gigantic impulse move, the more those waves play out according to the rules developed by, started by Ralph Nelson Elliott back in I think the 30s. And then, of course, Prechter and Frost took that and elaborated on it and actually applied a lot of statistical modeling to it to try and figure out if there was any validity to it. And I'm pretty well positive that they proved that, being that, after going through all of the price patterns and figuring out, how many actually conform to this idea put forth by Ralph Nelson Elliott, he then went on to trade a couple of trading championships where they would compete, right? You have to start off with a certain amount. I think it was 30,000. And well, he won that. And I want to say he won it 2 years in a row. And then he went on to have the biggest stock market, futures market analysis firm ever of all time. And throughout the 80s and 90s, their analysis was second to none. And they found the top in 2007 and the exact low in 2009. And then, of course, this I'm talking about the S&P and the Dow and the NASDAQ. And he he then continued to look for a lower high all the way up just about until the high was broken in recent years. So yeah, it looks as though, you know, standing back and looking at some of his analysis long term, we're talking about weekly charts and monthly charts. It looks as though, well, he doesn't do all that well, does he? It's not really all that useful. But the way in which he uses it is to find the massive turning points on the weekly chart. And if you've ever subscribed to their publications and intraday analysis, you will have seen some of the most amazing calls of just about anyone else out there in all of these other markets. So Elliott Wave is the framework, or let's say it's the road map. I think I said it one time as though it's the road on which I travel, but it's not the vehicle or the car I drive in, which means to say that I use Elliott wave theory to identify corrective patterns, which gives me a kind of a roadmap across multiple time frames, but it's not what I use to base my trading decisions off of. Okay. It helps me determine with a fairly high degree of accuracy, much higher than 55%, where we are within a particular move. Okay, and then it's the market geometry that helps me determine where the end of that move is most likely to be, where the swing high is going to be coming in, or where that swing low is likely to be put in. And then to confirm those areas, and there, it has to be a cross section of areas, I use the volume analysis that we've developed and the momentum divergence across faster time frames. So in testing all of these different systems and strategies that I've, it's over 1,150 with I don't know, it's over 300 people, something like that I've worked with. None of those systems that I built out for people ever made money consistently. Sure, they had profitable years. Some of them even had profitable 3 and 4 year stretches. But over time, if it's back testable, if there are enough rules in place to where you can actually, assign an exact bar on which you would enter the trade and the exact bar on which you would exit it, you can then back test it, and invariably they all tested horribly until we started massaging the numbers and optimizing, right? Everybody wants an automated trading system. I do too. I'd love to have one, right? But of all the proprietary trading firms that I know of out there, and I've spoken to many of the guys that run them, there's even one guy in Amsterdam that uses our tools for running his firm, which I think they have over a couple $100 million under management now. They all say the same thing. Yep, they're trying to work on fully automated systems. They maybe have a couple that are viable, but 80% of the money that they make is brought in by about 20% of their traders who are trading. While it may be a methodical system, they're trading discretionarily. So they may have some tools that help semi-automate that, but at the end of the day, they determine whether or not they're going to take the setup and how they're going to manage it. And I think I've said this a couple of hundred times. The entry really could be a coin toss. The exit is the most important part of the trade and how you manage it. Where your stop is located, where your target is, how you're going to manage it to the point that you either reach your target or you get stopped out. That whole process is what makes a good trader. Being able to handle that, manage the trade appropriately, and maximize the reward versus the initial risk on the trade. And there is no such thing as a risk-free trade. The risk is always the initial risk on the trade. So when you're in a hurry to tighten that stop up and go to break even so that you have a quote unquote risk-free trade, that's all just nonsense. It's all fairy tale. So I've put all this together over a number of years and proved it out in sim, and the results were way too good to be true, and I won't even talk about them. There's a video out there probably where I go over all that, but I wish it weren't out there because I think it gives people the wrong impression. Makes it look way too easy. But, you know, once you go live, those results kind of tighten up a little bit, but still pretty exceptional, pretty exceptional. So what it is that we're doing now to make it easier to understand, or let's say the way that I've put it together, even though for those of you that have it, it still may not be, you know, super easy to understand because I haven't given you all of the details that will be coming out as soon as this update is released. It is so much easier to grasp this than it ever was because I've split it into 3 main methodologies. Number 1, we're looking for corrections within a trend, right? So if I'm looking at the ES, let's say, which is here, there's my short right there. If it goes up to 3,300, I'm going to add one more short, 3,303 in fact. Okay, if we're looking at the ES, let's do this. How do I do this? How do I put all this together such that it can make sense? You'll notice I have a ton of charts, right? Well, I do indeed have a ton of charts, but we have 2 sets of workspaces. I have one set of workspaces that has each chart separated into one window per chart. Let's say there's on average 10 per workspace, including a daily and a weekly. There's another set that has just 5. So it may seem like it's a lot to manage, but That's one of the things that I've worked on recently, is making this more manageable, easier to handle, easier to use. And it's another reason this update has taken so long to get out. But what do I do? Okay. We're in a downtrend quite clearly, huh? We've got, and you can define that a number of different ways, but textbook definition, lower lows and lower highs, right? Well, we've clearly got lower lows and lower highs, don't we? Okay, this was the high. I want to say it's the first video in that email that I sent out. This is the one that we found in real time last Sunday night, right here. And I was talking about how picture perfect it is. This is the textbook short that we look for. And I should be going short right now, but I'm not, because I'm teaching it. And that's what I said in that video. So, and then that's what happened right there. Okay, so we're still in a downtrend. We had another setup here. This is where Bo shorted it. Or no, sorry, where did he short? Bo shorted it here and then got out here, I think. I don't know. Bo, you'd have to chime in and tell me where that trade was. I want to say it was right there. And then he found the B wave low, right? So this is an A. Sorry. Whoops. Yeah, it is an A. Let me do it like this. B, and then we're looking for C. But within that B wave is another A, B, C. So this is the Elliott wave part of it. This is simply identifying market structure and pattern recognition. So everything that a trader does in identifying an entry and an exit, it's all pattern recognition, despite whatever they may say to the contrary. Everything that we do in trading is everything that we do in life is pattern recognition. Well, if at least if you have eyeballs that work, hopefully. Pattern recognition, that's what we do. So what do you notice about that B wave low right there that you don't see at some of these other lows? Pretty massive amount of volume, huh? Relative volume, because it's in the overnight. The raw volume, or the truly traded contracts, the number of actual contracts bought and sold, is actually quite low in here because it's pre-open. It's 5:30 a.m. to 7 a.m. But with the relative volume, we're able to see when that demand is coming in at a low or when that supply is coming in at a high. And this was one that was found in real time. I can finally remove that, I guess. But that was the first sign of really clear supply coming in right here. And where is it at? It's right at that down sloping upper median line. Well, why do I think that's where it's going to come in? Well, because that is where that low came in, off of that same channel. So if we've rejected up out of an area, in fact, where the median line and the channel, those last couple of bars are touching both, well, then I've got a pretty good idea that if we go back and we hit the opposite median line, that's going to act as an area for supply. Okay, now this has nothing to do with Elliott wave. This is all purely market geometry, trend channels, median lines. It's just the way that the market unfolds. I don't know why. But I love it. It's just so incredibly interesting to me. It's just amazing. But working this stuff out has been just an absolute joy to me, really, because I love it so much. I love figuring these things out. And it's even a kiss goodbye from the low. So a kiss goodbye, just as an aside, if you will, is that, what is that? Well, that's when you break through an area and you pull back to it. So this is the lowest low. This is that last major low before we broke through. And as it retraces back up, this is textbook Edwards and McGee stock analysis of market analysis of stock trends, something to that effect, written by Edwards and McGee in 1972 or something. So that was the first or second book I had to read in Ecuador. And this was the type of stuff that I would draw for those guys. So I would have to go through the S&P 500, sometimes the NASDAQ, and just using trend channels and trend lines, mark up the daily, the weekly, and the 240-minute charts for them. And then pass it to them, and then they would fine-tune it and figure out which markets they were interested in that week. And they had a pretty good little system going. They were making decent returns, really decent returns. I'd say 18%. I think 1 year was as high as 20 something. That's pretty good with a big account, right? All right, so we're still in a downtrend at this point, aren't we? But the thing I have against me at this point is the fact that the lows that we've made recently are exceptionally high volume, exceptionally high volume. So that's the thing that makes me most leery about this short. And I attempted it early here at this first high and got stopped out. And that was Friday. And those recordings will be up sometime tomorrow evening, which I'll email out. Excuse me. I got a question from Miss Sandy. Shouldn't we see lower volume as the price hits the kiss goodbye? High volume means buyers coming in? No. So this is probably the hardest topic for anyone and everyone, is the way that the volume affects the movements of price. So the guy that came in Friday and was telling everybody that, indicators are garbage, you need to just trade with blank charts, just price action. He's what you call a price action purist. And my response should have been, well, let me show you my track record and you show me yours, and then maybe you can teach us how to trade, because you make way more than I could ever hope to make. And then, yeah, we'd see how that played out. Not very well, I'm quite positive, but the way that volume affects price, so the price action purist would say price is the first order indicator. price. No. Volume is the first order. First order meaning the actual cause, right? What's the underlying reason for prices moving up, prices moving down, or staying still? So it's the volume that creates the structure, the price action. And then people take and put all sorts of different equations on the price action, moving averages, oscillators, yada, yada, yada. They try to apply physics to it. It's not a physical object, okay? You can't apply physics to a non-physical object. It sounds good. It sounds like it makes sense, but no. Momentum is a useful topic to understand, but we had really high momentum right there, didn't we? And yet the market stopped on a dime and turned down. Okay. The way that I'm using momentum divergence is I'm first determining, number one, and this is part one of 3 separate parts. What is the operative time frame for the trade that I'm taking? And I'm determining that based on essentially the number of bars that make up the correction. So you see this one on the 30-minute at that high is no longer a setup on the 30-minute chart. It then becomes a setup on the hourly or the 15-minute RTH chart. This is the 15-minute RTH chart. And what did we do at that high as well? Came almost back to fill the gap. We didn't quite fill it, but we came within, so this is a 15-minute candle. When does the underlying instrument actually close? And I'm going to have to step away for a second in a minute just so I can breathe again. I think I'm not going to say it. I'm just having a hard time breathing here. The underlying vehicle is the S&P 500 stock index, right? So this is a derivative of the stock index. Well, when does the stock index close? Closes 15 minutes before the ES closes. So S&P 500 closed right there. Did we fill that gap? Aha, we did. It's interesting. And then we actually gapped up right here into it. So we filled it the day before. We got a churn bar. And Miss Sandy was asking, well, as it goes up, shouldn't the volume start to wane into that high? That's volume spread analysis. All right. That's Tom Williams. And that's why I don't use volume spread analysis, because it doesn't work. Even though it may appear that that's what this is not volume spread analysis. So the theory behind that goes, as you approach the end of a correction, you should start to see the volume drop off. So into a high, they would call that a lack of demand, right? You want to see the lack of demand. You want to see the volume dropping off into the corrective wave high. And then the opposite into what would be a strong uptrend and then a correction back down, you want to see a drop in the volume for a lack of supply into the low, lack of supply into the low. Well, that's not, in fact, the way the markets work. Why? Why is that? Why do the markets put a high in whenever they do, or a low in whenever they do? Well, it's one of 4 or 5 reasons. You can either just simply have what they would call a lack of demand into the high, where buyers are just simply no longer interested, and so they drop off. And then the kind of natural ebb and flow of buying and selling, the sellers just kind of overtake the buyers, and then the market puts in a high and it drops off. Okay, that does happen. Or what else can happen? You can go up and up and up and up, and then all of a sudden, bam, you hit a brick wall, and somebody's sitting there with their bag open, absorbing all of the buyers selling into it, and price is no longer moving up, even though volume is increasing. So you actually have an increase in aggressive buying, but somebody's sitting there limit order selling into all that right there. How do I know that? How could I possibly know that? Because the volume here, and just a slight change from one bar to the next, is significant, quite significant, depending upon the range of the preceding bars. So in this case, you've got a slightly narrower range than the preceding couple of bars, only barely, because you can see it. I mean, it's just barely smaller than these. It's a lot smaller than this one. Okay, but the volume is higher. The volume is actually 106%, and the volume here is 86.66%. Okay, doesn't look like much, but it's quite a bit, isn't it? It's 20%. 20% more volume, and yet the market moved less distance. It's weird, huh? And it's moving up into a high. What does that mean? That means that even though you have, let's call it 20% more directional force, if you want to apply physics to the equation here, even though you've got 20% more energy attempting to push the market higher, it's not moving any higher. In fact, it's moving less distance altogether. And by the close of it, it's actually closed off of its high a little bit. That is the clearest indication that you've got someone sitting there absorbing all of that buying, and they have begun to sell into it, and now the market has hit a roadblock, and it doesn't necessarily mean that it's going to turn there, but the chances of it turning there are becoming higher and higher and higher. And if you happen to be at an area in the market geometry, well, then you've got pretty good odds in your favor that it is actually going to turn there. And I want to say that's what this is. It's one of these. It's maybe not this chart. I don't think it was this chart at all. Let's see. Nope. What chart was it? It was the other one. That's why we have to use RTH, ETH, minute charts, and then ETH tick charts. And I've got to draw market geometry on all of those. And that's where people kind of tend to get lost. They're like, man, this is just too much work. Well, that's why we've made it easy for you. Easier. Every time I do my analysis and Bo does his, we've got this import manager here such that when I export my analysis, it will then take a screenshot of it, send it to the forum, and then that will show up here. And if you've got it set to import automatically, it'll import to your chart, your 30-minute chart automatically. Or you can make it use a pop-up timer. And if you're not in front of your computer, you can make it ignore it by the end of that countdown. Or you could make it import it by the end of that countdown. And on that pop-up timer, you have yes import or no decline, such that all of the work that we're doing, Bo and I, and then at some point, hopefully someone else can be helping us add more markets. The moment we mark up a chart, we send it to you, and there it is. You've got it on your charts for you. That's a game changer. That's a game changer for sure. Nobody has anything even remotely close to something like this. All right, so back to this. As we're coming down into that low, this is the brick wall. Really, really obvious brick wall scenario here. So at that point, the sellers picked up a lot of steam. Why do you think that was? Because we broke that low and we broke this low. You know, there's guys that teach breakout systems. So those guys are all going short there, while the big boys with the money are all going long, absorbing all that. And they need those public people. They call them dumb money, if you want to know the truth. They need the dumb money to go short so that they can build their big long position, which is what they did right there. It's sad, isn't it? Which is why I think a lot of the stuff being sold is not just people that don't know what they're talking about and just trying to make a buck. I think it's actually disinformation designed for you to lose your retirement. It's a sad, sick thought, but yeah. So this is the only thing that's scaring me right now, is the fact that we do have that really, really strong low. And what was I waiting for before I got into the short? I wanted to break that high. I wanted to hit at least 100% top of this channel, upsloping channel. But the typical distance of a flat, which is what this is, if it turns down, that's what it will have been, would have been. What is that? Pluperfect? Anyway, I needed 5 waves. I needed to be able to count 5 waves into that high, because that's Elliott wave, which provides the roadmap, right? I was calling this 3, 4, 5. But in fact, I think we're about to make wave 5 here, at which point I'll add one more just in case it's actually using this trend line for the area of resistance. Whoops. It's another cool thing about this. We've made it as easy as it can be for you to apply this analysis. And it actually works it snaps to the bars properly, which I can't say that for these tools for some reason. I don't know why, but it has trouble finding the ends of the bars. But anyway, yeah, I'm thinking that's a 3 and a 4, and we're making wave 5 now. So this is a short setup on the 30-minute chart. All right, that's number one. It took me that long to describe it. My goodness. Okay. That's just determining what is the operative time frame for the chart. We'll call this the 30-minute chart being the operative time frame for this short. Still in a downtrend, but we've got a really strong move to the upside against us. And if you're looking at a 5-minute chart, you're saying, well, you're not in a downtrend at all. You're in an uptrend. That's why it's all a matter of perspective. What chart are you looking at, and what chart are you trading? If I'm trading the 30-minute chart, as I am in this case, well, then what do I need? I need to confirm using the operative time frame and every subsequently faster chart to confirm, and I've got the confirmation here on the actual operative time frame. That's a pretty good sign of supply coming in at a high. Okay. So that's at a high, resistance, supply, resistance. At a low, it's demand, support. Support at a low is demand at a low. Supply at a high is resistance at a high. So now I need to look at the faster charts. I need to look at my 10-minute chart, which is here. And now that I've actually broken through the areas that got me into the trade, and I am using a little bit larger stops now because I've been working through some statistics that would lead me to believe that my results would be better had I used larger stops and not necessarily relied on, picture perfect pinpoint entries, but more focused on giving it room, letting it work itself out, and then managing the trade to the target. So now on the 10-minute chart, we've got a pretty clear area for that final C wave high, don't we? And we want to see what? For a flat, what is the most common fib extension for a flat? 138.2. Right there. 3303. Sure, Frank. If you don't, yep. So you don't actually have to have the whole master suite to sign up for Analysis Live. Each market is $99 a month, but we've had to make them different prices because of the way that our shopping cart works. It's a bit archaic, which is why I'm thinking of changing that as soon as I find somebody that can help with that. So all you need is the toolbar to get the market geometry, and then you'll also have the screenshots. See how I just exported this 10-minute chart? So then all these objects would show up on your chart. If you just own the toolbar, the only thing is we've got to make sure that your data feed is set to not back adjust the contracts together. Okay. So that's one of the first training sessions we're going to have this week. So before you guys leave, I know a lot of you are about to drop off here. It's getting late. This week I'm going to have 2 more days live, Tuesday and Wednesday. And then I'm going to have a final webinar that's actually structured to go over all that's in the master suite, all that's in the toolbar package. And the sale will end Sunday night, next Sunday night. So we'll have, one more session Sunday night as well. But I'm going to have Tuesday, Wednesday live trading where I'm doing this in real time. And then either Thursday or Friday, it might be Friday, we'll see, but we'll send that email out tomorrow. Then we'll do the kind of wrap up webinar as to, what all is included. And if you want to just get the toolbar and not have the full system, well, that's fine too, because you'll actually have charts showing you the volume and the momentum. And then we'll have videos describing the setup. Bo's been doing a good job of that. I've not done that because I've been busy trying to figure out the best way to do it. And this is not it. So the thing that I'm putting together now is going to be magnificent. I've just first got to get this update out, right? And then we're going to have training sessions. So a lot of those are going to be pre-recorded, very succinct 5-minute videos, but finally got some guys to help me start adding some proper structure to this thing so that we can begin to help more people. Because this really is the way that it's the way the markets work. It's very bizarre, maybe. But after you've seen it a certain number of days, you can't deny it. To deny is to lie. So let me carry on with this. So once we have the areas coming together as we have here, well, that's enough for the part 2. Part 2 is the signal from the market geometry, okay, which is this chart. This is the tick 1 chart. See, we had a lot of market geometry coming together back here. Okay, you had enough for something here, you had a long here, and it's not getting signals on the actual touch point. It's not able to use that line until 6 bars after the second click of it. All right, so I can't make it look, there's no back painting, there's no funny business going on here. That's deception. I'm not going to be a part of it. But you can see here, this whole way up, I've probably got some stuff on the faster charts that I haven't cleaned up yet, but it's showing you potential areas where you've got a bar touching one or more areas on one or more charts. Okay, just to show you what that looks like. This is it. So you guys don't have this version yet. This is a much refined version of the market geometry template. And this is looking at dividing them into 2 categories. Faster charts, LTF is lower time frames. HTF is higher time frames. Okay. One area sloping in favor of the trade, one area sloping against it. And then you can even, if you have a line, say, you can even use the volume profile and recolor those lines yellow, and those will be picked up. But I can color that horizontal line, what was it, 3303? And now if the market touches that or comes within a third of an average range on this chart, the chart that the line is on, it'll pick up that signal, and it'll add one more value. It's I'm not going to try to describe every single detail of how I built all this, but let's just say it's very, very, very precise. So if this is a setup on the 30-minute chart, well, that's the row 2 chart that will have the volume and momentum divergence confirmation. And that is what that template looks like right there. So this is the volume and momentum divergence confirmation using the higher time frames. So this is showing you from the min 3 chart, which is the 10-minute, all the way up to now the min 5, which is the hourly, but I'm adding the min 6 to this one as well. So there'll be one for the 138-minute chart, which I've already got on the 6E crude oil, and then I've just got to add it here to this one. So those are the 3 main markets that I can copy to any other market. The 6E covers all of the Forex futures. The crude oil covers things like gold, silver, any of those type of markets on the NYMEX. And then the ES covers everything else. So that's this chart. And we don't have a signal yet, but I bet when we get up to 3303, we likely will. Now, I did have one here in real time, and that's the thing about this. This is a real-time system. Okay, so the signals that you see historically may or may not have occurred in real time. What's interesting about this as well is that once you do get the signal, it may once you actually get the signal from the volume, by the time that bar closes, it may change, because the volume signal is based on not just the total volume, but the range of the bar and the volume per range. Okay, so I've got raw volume, meaning the total number of actual contracts traded, on top. That's a volume divergence signal as well. And then I've got the relative volume below that, and that little yellow line that's flat right there across, that's at 100%. So that's the average volume per bar per time of day. I could go into the details of that. I'm just not going to do it right now. But the skinny of that is, at some point in here, we did have the signal. And then by the time the bar closed, it changed. And how do I know that? Because this chart is the final chart that puts the signals together. Okay? And I had one right there at the high before the market closed, which is why I shorted right there. And then it was, I think I was up 50 ticks or something. Let's see. And that's how it all comes together. 51 ticks at one time, yeah. So I did have the signal in real time. Otherwise, it would not show up on this chart. But this one will hang on to it. So if it happens in real time, it'll show up here as long as it comes from both the row 1 or the row 2 and the market geometry chart, which is the tick 1. And this all sounds very confusing and just way too much to handle and yada, yada, yada. But look, everyone that's told you it's got to be simple. Keep it simple. KISS method. Keep it simple, stupid. Ask them to show you their trading results from their simple system. See if they'll send you their track record with their Renko bars and their awesome oscillators. Doubt it. Gotta love those Renkos, man. Anyway, guys, I'm going to wrap it up right there. That's a lot of detail. Yeah. It seems a bit daunting because it's quite, I mean, it's very, very, very specific what I'm looking for. And I'm looking for that because that's the only thing that I found that works. And it works to the extent that I not only have one hedge fund that uses it, but two that I know of. So there you go, whatever that's worth. And then we can go over my track record here whenever we have that webinar. And then maybe some of you guys out there that have made some money will get want to share yours too. I'll call Chris up and see if he can go over some of that. But yep, it is like drinking from a fire hose. But I threw it. That's what I sprayed you with it on purpose. I doused you. But that's why you gotta, like Sean's saying, one piece at a time. One piece at a time. And it's a lot to take in all at once, but that's why we're structuring it in a methodical, step-by-step process. We have that here. It just needs to be updated because some of these videos of mine, as you can very well see, can go for a while. So we do have a quite, I go into all the details of it here. I got a lot of stuff written out. How to do this, how to do that, market geometry, Elliott wave, a lot of resources on that. There's a lot more that I can add here, but we're doing it properly this time. There's no reason that these need to be 2 hours long. They should be 5 to 10 minutes, topical, and easy to go through. And then these are all the training session recordings here that you can search through. Topical as well. And that just goes on for days. So, all right. You guys have a good one. Oh, man. Enjoy my evening. I wish I could, Jim. Ciao, Frank. I got to finish this or else. Oh, my neck hurts. All right, you guys have a good night. I'll talk to you on Tuesday. I was going to send an email out after this, but I'm going to work on that update instead. I'm going to send you an email tomorrow. For some of you guys that have been signed up, in order to stay signed up, you may need to go in and confirm your trial. It's going to happen by default, but you may see that payment go through tonight, just so you know. And you can manage all of that under my account. Manage subscriptions. You see that? You can update your credit card here, invoices. So you can manage your subscriptions here. And it'll tell you what you're signed up for. You know, we're adding the NASDAQ tomorrow. And I'm going to do that one myself for a little bit. I'm not going to ask Bo to do more than he's already doing. But we are going to add the NASDAQ too. So we'll have the NASDAQ, the ES, S&P 500, CL, crude oil, light sweet crude futures, and then the 6E, Euro currency futures. And those will be the main four that we'll do for the next couple of months until after we built out this course and can handle more. So, all right, you guys, y'all have a good one. Yeah, I'm going to do the live room again Tuesday and Wednesday. And I'm going to open that up to everybody again 2 days. And then I'm going to have a final webinar Thursday or Friday. And then the sale will be over Sunday night following, well, at midnight, but following our last, it's not going to be the last, it'll be the typical Sunday session where we're actually going over the market geometry for the coming week. All right, you guys, y'all have a good one. I'll talk to you on Tuesday. All right, bud.